Recent economic data may be a sign that an increase in interest rates is off the table for this year, something that Keith McCullough has been saying for a long time. Yesterday, I sat down with former Federal Reserve Chairman Ben Bernanke. Here's what he said when I asked him about rates and what's holding back the U.S. from raising rates right now.
In the near term, I think that the domestic U.S. economy is moving along pretty well. You know, the housing sector is coming back, a lot of jobs being created. I think the drag we're seeing right now is coming mostly from the international economy.
Yeah, no surprise there. My next guest says Bernanke is ignoring other problems, even though if he doesn't see issues in housing. Joining us right now is James Rickards, best-selling author of The Death of Money. James, good to see you.
Morning, Maria.
Thank you so much for joining us. What is Bernanke ignoring right now?
Well, he's probably right. There's no bubble in U.S. Housing, but there are bubbles in emerging markets, dollars-denominated corporate debt, commercial real estate, which he hasn't talked about. It looks like a bubble. So there are bubbles all over the world. But we know the Fed is lousy at seeing bubbles. They never see them. They didn't see the tech bubble. They didn't see the 07 bubble, the emerging markets bubble in 1997, Mexico in 94. They missed them all. So I think he's right about housing, but there are bubbles everywhere.
To be clear, he also felt like, to me, that he was in no rush to say the Fed should, in fact, raise interest rates anytime soon. So, yes, he said that the economy is improving, coming along, but he didn't really feel, to me, my takeaway, that he thought there was any problem with rates to stay where they are.
Is he not employed by companies that run with levered expectations to asset prices?
Consultant said it all, but he's at Brookings, so he does have a sort of an academic think tank. But I spoke to the former chairman in Korea, and he said exactly that. He actually said the Fed doesn't care if the stock market goes down 15%. He said it's not our job to prop up the stock market.
But he is watching global markets.
Sure, but the problem in global markets, China's slowing down. That's affecting us. But the reason China's slowing down is because the Fed has been tightening for 2 years. As China pegged their currency to the dollar, the Fed's been tightening for 2 years with tapering, removing forward guidance, and then tough talk on raising rates. They haven't actually done anything to raise, but you talked about it.
But you think that's? Do you agree with that? That's tightening
on the margin? That's the whole reason why the dollar went up so fast and gold had some problems. Is that you had a hybrid tightening by not loosening. Now the question is, does the Fed force itself to actually ease relative to all of that? That is the currency war. Jim, you're the author of this.
That's what I expect. I actually think the Fed's next move will be toward ease, probably by restoring forward guidance. They'll put, if it's not patient, forbearance, they'll throw some word in the statement. And that you can talk your way through tightening and easing cycles.
So that will be their easing.
Correct. Either forward guidance or the currency wars. They just cheapen the dollar. Call Draghi and say, hey, it's our turn. We're taking the canteen back. We need a sip. So we're going to cheapen the dollar.
Cowbell.
Well, that's what's really moved macro markets. It's certainly what's moved my inbox, Jim, in the last 3 days, which is everybody and their brother saying, can oil go higher? Can the dollar go lower? Can oil stocks go higher?
Right.
Isn't that the game that the Fed is engaging in?
Sure, you've got to get commodity prices higher. I mean, oil is going to trade in a range 50 to 60 through 2017. That's really been driven by Saudi Arabia.
50 to 60 is your
50 to 60. No, it could overshoot. Obviously, it's been lower than that, but that's to put the frackers out of business. They did a linear programming problem. $60 was the magic number. No, they did. It's good information on it. It destroys the frackers, but doesn't hurt the fiscal situation in Saudi more than necessary.
Right. The Saudis have been wanting to do that. Right. Yeah, I agree with that.
And they're sticking the landing there.
But the OPEC has no control over Russia, and Russia's been pumping at a post-Soviet high in the month of September.
Right, but then Saudi can just tighten a little bit. So Saudi has the lowest cost and the largest reserves, so they're the price setter.
Well, on this, Jim, you're one of the thought leaders, obviously, on this topic. How much wherewithal does the rest of the world have playing the currency game versus who we have? We have like Obama.
Right.
We have Jack Lew. We have fantasy football would be dead if we had that team.
Well, that's a very important point, Keith, because historically the dollar was the Treasury's job, and the Fed did not worry about the exchange value of the dollar. That has changed. Now, Bernanke gave that speech October 2012 in Tokyo, where he said to the rest of the world, hey, we're the world's biggest economy. If we go down, we take you with us. So we need a cheap dollar to help the U.S. And that was his explanation for 2011. Now, the reason the dollar got stronger was the tough talk from the Fed, but that was a blunder. They thought the U.S. economy was strong enough to bear it. Turns out that's not the case. So we'll go back to the cheap dollar playbook.
Well, the economy is absolutely hooked on cheap rates. I mean, this morning, mortgage purchase applications in the U.S. went up 27% after that jobs number.
You were surprised by that big number.
Huge number, but it also explains partly why the stock market goes up. People want lower rates. They're addicted to it, are they not?
That's exactly right. So, as soon as the Fed talks ease or backs away from the tough talk, the stock market goes up. When they say, well, we're going to raise rates before the end of whatever, pick a year at this point. No, actually, I think they get into, if they can't raise by March, and I don't think they will, You're talking about 2017.
Wow,
March of 2016 you pushed.
now?
Yeah. I'm not. I actually think their next move is to ease, but if I'm wrong, the data's stronger. Maybe they raise in March 2016. If they get past that, you're in election season. They don't want to. They'll either anger the Republicans or the Democrats, no matter what they do. So they'll just keep out of it.
One of the big stories, Jim, of the morning is oil. Okay, so it's up 2%, headed toward $50. That's sort of Keith's range, 40 to 50.
Right.
Would you sell oil at this point?
No, I'm a buyer right here. Because oil's an easy trade. So it gets down to low 40s, you buy it. It gets up to close to 60, you sell it. Because it is going to be in that range. So just trade the range.
Mm-hmm. Can I add one thing?
No, it's not at 60, Jim. It's at 50.
No, well that's right.
Well, now it's in the middle of the range. But you could have bought all the oil you wanted at 40.
Right, but if you see it getting close to 60, seller. If it's 40, buyer.
Sorry.
No, it's related to the fantasy sports discussion we were having and how Wall Street firms basically will use their own book to trade against you. There is no better example of that happening than oil. So if you're trading oil, you better watch your what. Right? Because you're trading against essentially.
To Jim's point on the risk.
Name that big investment bank.
On the risk of the range, what people do is that they chase price.
Right.
This is just the most behavioral obviousness in the market that I see. When it's up, they buy them high. When they're down, they sell them low.
Exactly.
And that's why hedge fund performance is putrid.
Right.
I mean, it's terrible.
There are just smart people calling for $15 oil. Friends of mine, they're good guys, but they're like 50.
Well, Goldman's calling for 20, and they call for 200 at the very peak.
Actually, that was the day to buy oil. When Goldman said it was going to 20, you could have bought it that day at 39 to 40 or thereabouts.
Wow, you're right.
Yep.
I spoke to Goldman traders, the head of commodities trading. They don't listen to their own research department. They said nobody listens. No, they said nobody listens to those guys. They're all ex-Fed guys with Fed models or women, and so we don't listen to them ourselves because we know better.
Wow,
I didn't say it.
Jim, good to have you on the show today.
Thanks, Maria.
Thank you so much for your insights. As always, Jim Rickards joining us there.